Hey traders, welcome back to Trader DNA. What if I told you one single candle on your chart can reveal the entire battlefield between buyers and sellers and give you high probability entries over and over again? Most traders ignore this, but today you won't. When most traders analyze market structure, they mark the obvious highs and lows to define the range. That's the traditional approach. Swing high, swing low. Build your bias from there. But candle range theory changes the way you see the chart. Instead of only focusing on overall structure, this concept teaches that every single candle holds its own range. Every single candle. And once this clicks, your chart will never look the same again. Look at this daily candle, but now view it on the 1 hour time frame. Notice the wicks, that daily high and daily low. On the lower time frame, those exact wick points become swing highs and swing lows. That means this one daily candle contains its own internal structure, its own isolated range. It's like a complete mini market, hidden inside a single candle. And yes, on the surface this sounds basic, high, low, range, simple stuff. But when you combine this with smart money concepts, when you understand how liquidity is being built, manipulated and taken inside that one candle, that's when things get serious. That's when a single candle setup can consistently produce high probability trades. You're not just staring at candles anymore, you're breaking them down. You're reading the story inside the wick. You're seeing where liquidity sits. You're spotting where the real move is likely to begin. In this video, we've broken down everything you need to master candle range theory into 5 simple, actionable steps. Clear, structured, and built for real execution. Alright, no delays, no filler. Step number 1. This is where we turn candle range theory into actual trade setups. This entire strategy runs on a 3-candle framework, just 3. But each one has a specific mission. If one candle fails its job, the whole setup collapses. So pay attention. Let's start with the first candle. Right here, we've got a bullish daily candle. Now yes, if we drop down to lower time frames, we can dissect this candle with more and more precision. 1 hour, 15 minutes, 5 minutes. The lower you go, the more detail you see. But here's the powerful part. For this strategy, everything we need, all the price action data, is already contained inside that single daily candle. We don't need extra confirmation. We don't need extra indicators. It's all right there. What does this candle actually tell us? It tells us that on this specific day, price opened here and it closed up here. That's the body. And the highest price reached during the day, that's the top wick. The lowest price, that's the bottom wick. Simple information, but extremely powerful. Because in candle range theory, those wicks are not random. The top wick and the bottom wick act as isolated liquidity levels, independent targets, magnets for future price. And if you think about it, this makes perfect sense. Open any random chart, scroll anywhere, you'll notice something almost mechanical. Most candles will attack either the previous candle's high or its low. Price constantly seeks liquidity, so within this framework, the first candle has one job: define the range we care about trading. That's it. It draws the battlefield. The high of this candle becomes the candle range high, the CRH. The low becomes the candle range low, the CRL. That's your range. That's your map. Now you might be asking, which candle can we use to define a tradable range? The answer is surprisingly flexible. Technically, any candle on the chart can define a range, daily, 4 hour, 1 or any time frame. But, and this is important, not every candle is ideal. There are specific criteria that help us decide which candle gives us the highest probability setup, and we're going to break that down later in the video. For now, just understand this. Candle 1 defines the range. CRH at the top, CRL at the bottom. And that range becomes the foundation for everything that comes next. Now let's talk about the second candle, because this one decides everything. This candle is the judge, the filter, the make or break moment. Without this candle doing exactly what we need, there is no setup. Period. Here's why. The entire concept behind candle range theory revolves around one powerful idea. If price attacks the candle range high, the CRH, but fails to close above it, then there is a high probability that price will reverse and target the candle range low, the CRL. That's the engine behind the setup. So what do we want to physically see on the chart? We want the second candle to push up aggressively. We want it to trade above the first candle's CRH. We want it to grab that buy-side liquidity, take the stops, trigger breakout traders, create that illusion of continuation. And then we want it to fail. We want price to get dragged right back down into the range and close back below the CRH. That move right there, that's the liquidity sweep, and it is absolutely crucial, because if instead the second candle pushes above the CRH and closes strong above it, that's not a sweep, that's acceptance, that's continuation behavior. And if we get a strong close above the candle range high, then the candle range theory setup is invalid. Done. Off the table. Why? Because now the probability shifts. Instead of reversing toward the candle range low, the market is more likely to keep pushing higher. So understand this clearly. We need the attack, we need the sweep, we need the failure to close above. That rejection at the CRH is what creates the imbalance. That's what signals the potential shift. That's what opens the door for price to travel all the way down toward the first candle's range low, the CRL. No sweep, no setup. But if that second candle sweeps liquidity and closes back inside the range, now we're in business. Now, if the second candle meets all the criteria, this is where things get exciting, because now we shift our focus to the third candle, and inside that third candle we start hunting for our short entry with one clear objective: target the candle range low, the CRL. That's the mission. Now yes, you can hold the trade longer if the external market structure supports further downside. If higher time frame structure aligns, you can absolutely let it run, but strictly within the rules of this setup. Once price trades through the candle range low, the CRL, the 3-candle model is complete. Objective achieved. So at this point, we've broken down candle range theory conceptually. You understand the logic, but now let's actually execute it. Let's drop down in time frame and walk through how we navigate this setup step by step, like we're watching it unfold live. Here's the first daily candle again. At the high of that candle, we have buy-side liquidity. At the low, we have sell-side liquidity. Those two levels, that's the range, that's the battlefield. Now we move to the second daily candle. And the very first thing we notice, the sweep of buy-side liquidity. Price pushes above the previous high, it takes the stops, it triggers breakout buyers, it creates that illusion that we're about to explode higher, and then it collapses back down into the range. That sweep is critical, because when buy-side liquidity gets taken, it usually signals that price is preparing to move toward the opposite pool, the sell-side liquidity. So the liquidity sweep is phase 1 of the setup. Now we look for phase 2. We want to see a change of character. Specifically, we want price to break below the bullish leg that created the sweep. That structural shift tells us something powerful. Bearish momentum is stepping in. Control is changing hands. And if we're planning to short, that's exactly what we need to see. Then comes the final piece. During that bearish leg, the one that caused the change of character, we want to see a bearish fair value gap, an FVG form. Because that FVG, that's our PD array. That's the zone we're actually going to use for entry. So let's tighten this up. Candle 1 defines the range, CRH at the top, CRL at the bottom. Candle 2 must sweep liquidity and show structural weakness. And candle 3, that's where we execute. We short the bearish fair value gap and we target the original candle range low, the CRL. Now it's worth mentioning, a lot of traders using this model choose to enter on a breakout of the second candle's low. But breakout trading is inherently riskier. You're chasing momentum. Using internal range liquidity IRL as your entry reference gives you far more precision. And if we already anticipate a move lower, the fair value gap naturally offers a cleaner, more favourable entry price anyway. Better structure, better positioning, better control. And once price hits that first daily candle's range low, the CRL, the full 3-candle setup is officially complete. That's the bearish model. And yes, there's also a bullish variation built on the exact same fundamentals. The only difference? Instead of manipulation at the high, we look for manipulation below a bearish candle's range low, the CRL, and we target its range high instead. Same logic, same mechanics, just flipped in the opposite direction. Alright, now that we've locked in the basics of candle range theory, let's level this up. Step 2, and this is where most traders get it wrong. A candle range theory setup does not have to be only 3 candles. We started with the 3-candle model because it's the cleanest, simplest way to explain the concept. It's easy to visualize, easy to follow, perfect for building the foundation. But in real market conditions, there is no fixed rule for how many candles it takes for a CRT setup to complete. 0. Because the number of candles doesn't matter. What actually matters is this: the market structure must clearly form an AMD pattern. That's the key. AMD stands for accumulation, manipulation, and distribution. These are the 3 phases inside the smart money concepts model known as the power of 3. And the trade entry? That happens in the distribution phase, but only after we've seen clear confirmation of accumulation and manipulation first. Now look at this chart. You can literally see the AMD structure unfolding. We start with the first candle. That's our defining candle. That's where we mark the candle range high, CRH, and the candle range low. That's our range. Then what happens next? We get a cluster of candles, and notice how they barely move price in either direction. No aggressive expansion, no breakout, just compression. That right there is accumulation. Price is building positions, liquidity is forming, energy is loading. Then comes the next candle, and boom, it sweeps liquidity. That's the manipulation phase. Price pushes above the range, grabs stops, triggers breakout traders, and then pulls back inside. But remember, this is critical that manipulation candle must close back within the range. If it closes strongly outside the range, the short setup is void. It's invalid. The structure shifts. But if it sweeps and closes back inside, now we're set up. Then what follows? 2 strong bearish candles that drive straight toward the candle range low. That's distribution. That's where price expands aggressively in the true intended direction. And that distribution phase is where we look for our entry after manipulation has been confirmed. So what's the big takeaway here? The real edge in this strategy is not counting candles. It's identifying the correct market structure. You're hunting for AMD. Now here's where it gets even more interesting. With this understanding, you can actually find valid CRT setups that involve only 2 candles. But to see how that works, you have to drop down to a lower time frame and dissect the second candle. And when you do, you'll notice something powerful. Inside that single higher time frame candle, there's another AMD structure. You'll see a small accumulation phase, then a liquidity sweep, manipulation, then a push down, distribution. It's fractal. And from a market structure perspective, after that liquidity sweep, price creates a clear change of character, a 𝗙𝗢𝗘𝗘. That break signals momentum shifting bearish. Then price uses the bearish fair value gap, the FVG, as a catalyst, as fuel to drive into the candle range low. So what does this all mean? Time is relative. There is no specific number of candles that a CRT setup must take to complete. It could be 3, it could be 5, it could be hidden inside 2. The only thing that matters, the only thing, is that the correct AMD market structure is present. Find the structure and you find the setup. Bonus. And to make your entire analysis process ridiculously easier, I've got something powerful for you. An indicator that's insanely effective but incredibly simple to use. Now listen carefully, because when you combine this indicator with the exact analysis technique I'm showing you in this video, you suddenly unlock a very, very powerful trading strategy. And that's exactly why you need to have this indicator. This tool delivers extremely accurate entry signals with visuals that are so clean and simple, even beginners can instantly understand what's happening on the chart. And don't worry, I'm going to explain this indicator in full detail at the end of this video. All right, let's move to step number 3. And this is where precision comes in. This is how you pair time frames to actually execute entries using candle range theory. Now that we understand the core mechanics of CRT, we need to talk about planning, because knowing the concept is one thing, executing it correctly is another level. So look at this. We're on the daily time frame, and price has just attacked a buy-side liquidity level. This is a pivotal moment. With our smart money concepts knowledge, we know this is the decision point. Is it a liquidity run where price keeps pushing higher? Or is this a liquidity sweep where price grabs stops and then reverses? That's the question. And that's exactly why this scenario is perfect for applying CRT. We isolate this candle, we mark the candle range high, the CRH, we mark the candle range low, the CRL. Now we know the rule. If the next candle sweeps the range high, the CRH, there's a strong probability that price will target the range low, the CRL. But here's the problem. If you just sit on the daily time frame and watch this unfold, you don't actually get enough information to justify a trade. Yes, you'll see where the second candle opens. Yes, you'll see where it closes, but you won't see the internal market structure. You won't see the change of character. You won't see the displacement. You won't see the fair value gap forming. And without that structural confirmation, you're trading blind. This is why time frame alignment is everything. We use the higher time frame for one job only, defining the candle range high and candle range low. That's it. Then we drop down to a lower time frame, and that's where we dissect the structure. That's where we confirm whether there is a valid tradable setup inside that candle. This concept is called time frame alignment, and it's not optional. We use it for every smart money concept setup. Every single one. Now, for those who are new, let me make this extremely clear with examples. If you're analyzing a monthly candle using CRT, you don't enter on the monthly chart. That would be insane. You define the range on the monthly. Then you drop down to the daily time frame to look for the ideal market structure, the AMD model, the sweep, the displacement that gives you a real entry. Another example, if you're analysing a 4-hour candle, you define the range there. But your entries, you refine them on the 15-minute time frame. Higher time frame defines direction and range. Lower time frame confirms structure and execution. That alignment, that precision is what separates random entries from calculated setups. Define high, define low, drop down, confirm structure, execute with intent. All right, now we're stepping into step number 4. And this is where you stop taking average entries and start taking elite ones. When you're looking for entries with CRT, you must target the ideal premium and discount areas. This is non-negotiable. We already know that a single candle represents its own isolated range when broken down on lower time frames. That candle has a high, it has a low, it has a midpoint. That's a complete trading range. So if a candle is its own range, then we trade it like any other range. Same logic, same rules, same discipline. Now let's say we're using a bullish candle to define our CRT range. That means the candle closed higher than it opened. It's bullish. In that scenario, we're looking for a short setup. And if we're looking to short, we don't just enter anywhere inside the range. That's amateur behavior. We want premium. The premium area is anywhere above the 50% midpoint of that candle's range. Draw a Fibonacci from the low to the high. That 50% level splits the range in half. Everything above it, premium. Everything below it, discount. So if we're shorting a bullish CRT range, we want our entry inside premium. We want to sell high within the range, not randomly in the middle, not at the lows. Now, fast forward. When we break down the next 2 daily candles on a lower time frame, we spot a bearish fair value gap forming. And here's why this is powerful. The FVG not only satisfies all the structural criteria, the sweep, the change of character, the displacement, but it also sits inside the premium area of the range. That's confluence. Structure plus location. That is a high quality short entry. Now flip it. If we're using a bearish candle to define our CRT range, meaning it closed lower than it opened, then we're looking for long setups. And in that case, we don't buy at premium, we buy at discount. That means we look for bullish setups forming below the 50% midpoint of the candle's range. Anywhere under that mid-level is the discount area. So now we're buying low within the range instead of chasing price higher. And this is critical. Trading inside premium and discount ensures you're positioning yourself with the best possible risk to reward. You're not just trading structure. So you're trading structure at the right price, high probability, high precision, better RR. That's how you turn a good setup into a calculated one. All right, we're at step 5. And this one might be the most important of all, because this is where we talk about when you should and when you absolutely should not use CRT. Candle range theory is powerful. Extremely powerful, but only when it's applied in the right environment. Let me show you exactly what I mean. Right here, we've got a bullish candle. After that, the next candle sweeps the candle range high, the CRH. Clean liquidity sweep. looks textbook. So with just that information alone, you might immediately expect the third candle to drop and attack the candle range low, the CRL. On the surface, it looks perfect. But this is where most traders mess up. They see the pattern and they ignore the context, because the real question isn't just, is there a sweep? The real question is, does this setup make sense within the external market structure? Now zoom out. Look at the full range these candles are sitting in. When we analyze deeper into the chart, we realize something critical. For price to push down past that candle range low, it would have to break through a bullish fair value gap. And not just that, that bullish FVG is overlapping with a bullish order block. That's stacked buying pressure. So now think logically. If strong bullish PD arrays are sitting right below price, does it really make sense to expect a clean bearish continuation? No, at this point, after proper analysis, our buyers should actually lean bullish, which completely contradicts the original CRT short idea. And what happens next? As expected, the setup fails. Price doesn't collapse lower. Why? Because of the strength of the buying power inside those bullish PD arrays. This is why context matters. Now let's look at a different example. Here we have another potential candle for a CRT setup. But this time the setup has serious potential. Why? Because it's happening at an important point of interest, an active attack on liquidity. And this is how you should think about candle range theory. CRT is essentially a reversal detection tool. It helps you determine whether price is about to shift direction. So when price is attacking liquidity, that's a critical moment. Is this a liquidity run, continuation, or is this a liquidity sweep, reversal? CRT helps you analyze that in real time. But, and this is huge, you still must assess lower time frame structure. You never take a trade purely from the higher time frame. Never. The higher time frame gives context. The lower time frame reveals intent. You have to see how the structure is forming beneath the surface. Another powerful way to use CRT when price is drawing into a PD array, like this bearish fair value gap right here. After a clear change of character, a 𝗙𝗢𝗘, we already have reason to believe price may reverse from that zone. So what do? We use CRT as confirmation. We use it to determine whether that fair value gap is actually being respected, or if price is about to ignore it. So here's the real takeaway. Candle range theory is an extremely effective tool for identifying and trading reversals, but power without context is dangerous. You must understand when to apply it. Use it during liquidity attacks. Use it around PD arrays. Use it when structure supports a reversal. Bonus. And to make your entire analysis process ridiculously easier, I've got something powerful for you. An indicator that's insanely effective but incredibly simple to use. Now listen carefully, because when you combine this indicator with the exact analysis technique I'm showing you in this video, you suddenly unlock a very, very powerful trading strategy. And that's exactly why you need to have this indicator. This tool delivers extremely accurate entry signals with visuals that are so clean and simple, even beginners can instantly understand what's happening on the chart. And don't worry, I'm going to explain this indicator in full detail at the end of this video. Now take a look right here. This is the most basic way to trade using this indicator. When the indicator turns blue, that means it's giving you a buy signal. And as you can clearly see on this chart, right after that signal appears, price explodes upward, giving you a huge profit opportunity while your stop loss stays very small and controlled. Then right here, the indicator flips to red, which means the trend has shifted to bearish. And now you should only be looking for sell entries. And as you can see for yourself, price drops hard, delivering another massive profit move. Next, the indicator switches back to blue, which means it's time to buy again. And just like before, price launches higher and gives you another powerful upside move with maximum profit potential. Then the indicator turns red again. That means we immediately switch to sell entries. And just like before, price drops deeply, delivering another large profit opportunity. Now watch this next part. You take a buy entry right here, but this time price hits your stop loss and the loss is very small. Then the indicator flips to red, so you immediately take a sell entry and once again price drops hard and gives you another big winning trade. After that, the indicator turns blue, So you take a buy entry, but this trade also hits stop loss, and again the loss is very small. Then the sequence continues. The indicator switches back to red, you take a sell entry, and just like before, price drops strongly and delivers another big profit move. This is truly an incredible indicator. To help you get started with this indicator, I've provided the exact tool so you can easily use it on your own trading platform. If you want the exact same setup you see in this video, no guesswork, no manual plotting, I've got you covered. You can download the full indicator template and trading system directly from the description. Just add it to your chart and everything will be plotted automatically, accurately, and instantly. No hassle. No confusion, just focus on learning, executing, and improving your trading skills. And as always, if you learned something new today, or if you want more videos like this coming more often, make sure you subscribe, turn on notifications, and share this video with your WhatsApp groups, Facebook friends, or on X to show your support. I'll see you in the next video.